I'm terrified of retirement because I don't want to spend any of it. I don't know if the market's going to crash. I don't know if I'm going to live 50 years, and I can't make this money again.
Welcome back to another episode of Wealth Easy, where we talk all things wealth, health, and real estate. I've got a real great guest for you today. He has a PhD in retirement planning. He's been featured on Fox Business at CNBC. He's a keynote speaker, a retirement income expert, and the author of Permission to Spend. I've actually got a copy of his book and read it. Please welcome to the show, Tom Wall.
Great to be with you. Thanks for having me, John.
Thank you. Thank you for making the time to get on the show. I know you have a really busy schedule. We were actually just together last month down in Hollywood, Florida. You have a fast forum that you put on for a couple of days, and there was about 500, I think it was 400 or 500 advisors from around the U.S. that came. I mean, I came from Canada, so
Yeah,
it was a really great show. Tell me, I mean, there's a lot of work that you put into having a conference like that and getting together speakers. What's that like? You know, trying to find speakers that actually fit with the narrative that you're trying to get out there to the advisors.
Well, look, I mean, we've all been to a ton of conferences in our careers, and most of them are hit or miss, in my opinion. You know, even some of the best, biggest industry conferences, I find myself going and looking at the agenda, picking out the people I'm going to listen to, and then I'm going to go, mess around and do something else during the downtime. And, I've always wanted to kind of create my perfect conference, the one that I would want to go to, where I would learn the most from around my superpower expertise, which is, retirement planning using actuarial science, life insurance and annuities and things like that. So I curated a list, and I don't know why I do it. Honestly, does any entrepreneur know why they do stuff? So they get passionate around something and they want to build. So it's been really the honor of a lifetime to do that. It was my second event. The first one had just under 200. This one had just over 400. And I'll probably continue to do this for the foreseeable future, just bringing in new voices and just rallying people around this part of the financial planning world, which I think is, in my opinion, one of the most underserved, which is just focusing on, using actuarial science, life insurance, annuities to shift risks versus what most people are doing is just getting hooked on financial entertainment and all their, fun simulations and pie charts and graphs that don't provide any real guarantees or financial security when times are tough.
I know, and I've been following you for a while. And before we actually met, I've got a copy of your book here. I read it. I thought it was absolutely fantastic. And you filled the 2 days with some pretty amazing speakers. I ended up connecting with some great people. Izalfi Taylor. I had Izalfi on a couple of weeks ago. What a great dude. I mean, high energy. Spoke really well, brought some very good, I think a lot of great content and value to the show. You had Vince Theodore on there. You've had a lot of great speakers. And I found myself actually, like what you said, going through the list and going, you go to conferences and I want to hear that guy. No, I'm not interested. I found I wanted to listen to every single person. So, congratulations to you for putting on a really great show. And I'm really looking forward to next year's show and having seeing even more advisors there, and hopefully we can get some more people from Canada down there.
Yeah, well, thank you. We're hard at work on the next event. Hopefully I'll secure a location in the next few weeks.
So you've been in this business a long time. You're not that old, but you've been in the business from a very young age. Give my listeners a 2-minute bio on yourself and who Tom Wall is.
So I started in the business, hard to believe it's been 23 years now. I started as right out of college as a 21-year-old. I was actually in college selling life insurance for Northwestern Mutual. Just did that for a couple of years before moving my practice to Mass Mutual. So spent about 4 years as an advisor before leaving the field and actually joining a home office where I very quickly became a life wholesaler. So I have spent the majority of my career, really all of my career, positioning whole life insurance to clients, to advisors, and helping compete against its alternatives. In that process, working at the home office and being a life wholesaler, I really wanted to round out my education and be able to speak to the highest minded investment advisor, talk about estate planning, talk about investments. So ended up putting together a couple master's degrees and ultimately a PhD in that process, just one course at a time over the course of about 15 years. And I came out the other side of that, kind of I got a little tired of the home office. I was basically paid what they wanted to pay me. I was working for somebody else at the end of the day, and I had that entrepreneurial bug in me where I really wanted to go back out. I wanted to publish my first book as I wrapped up that PhD and do a lot of the speaking I had been doing as a wholesaler, but on my own terms with my own brand and and speak to the space in our industry that I mentioned before, I think is underserved
Mhm.
of advisors who are focused on protection first planning in a holistic format versus what I have seen happen in the financial planning space, where most of the industry has moved toward fee-based planning, investment planning, wealth management, all really good things that help clients. But if they're not, but they've kind of gotten away from having the core conversations around, protection and risk management, which is true, which is really what financial planning is about. So I've been doing that for about 5 years, and on my own, I have assembled an almost 1,600 person mastermind group. So advisors around the industry that are part of my weekly programming.
Which
It
I'm
got so
involved
successful.
too. I'm now involved
Yep.
in that.
So that got so successful that I said, you know what, why don't I host a live event? So that's why, I kind of threw one together at the beginning of last year, and then at the beginning of this year, just a month ago, we had the real big one, which was fantastic. And I continue to, I'm on airplanes every week. I'm in a different city every week, talking to some new group of 100, 200 financial advisors about these concepts and helping them talk to clients about it in a way that is not confusing, cuts through the noise, and is objective and fair and not product pushing, but solution, pushing, which is I think where advisors miss too. They spend so much time on features and benefits and riders and not about what is the outcome we're trying to provide.
So you're no longer you're not selling insurance anymore, but you were a top advisor at Northwestern Mutual and then Mass Mutual, and then you left there to train hundreds of thousands of advisors. What made you make that switch from producer to coach?
You know, it's a great question. I enjoyed speaking to many. I was just kind of nerdy about it. I wanted to run the calculations. I wanted to run the illustrations. I wanted to know how the watch was made.
Yeah.
I think there was this almost fear inside me as a young advisor. When you're an advisor in your 20s and you're talking to people in their 50s and 60s with real dollars, you have this imposter syndrome and you have this lack of confidence and really I think the bigger lack is conviction. Just like that this is exactly right and this is what they should be doing. So I found myself, pulled toward more of an academic role, which is what those home office roles were, is more of, being the product expert, being the solution expert. As I like to say, financial advisors are generalists, just like your primary care physician is a generalist, and they send you to a specialist if they need something. So I just really wanted to specialize in this, but along the way, I realized I had a unique ability to not just be, the nerdy technician. There's no shortage of those in our business, but also I had the ability to communicate it in a way that simplified complex concepts down so that people could understand. And I think once I found that was my superpower, that's when I really, enjoyed that role of training and developing advisors. Because if I want to make a maximum impact, I can do it with several hundred clients or I could do it through several hundred thousand advisors and eventually, impact millions or tens of millions of Americans in the process. So
Well, it all trickles
um,
down. Yeah.
that's kind of what I'm doing here. Yeah,
Yeah.
it's been a lot of fun along the way.
Hey everyone, it's John. I just wanted to thank you for being here, and I would ask that you please subscribe to the show by just clicking the subscribe button right here. I'd really appreciate it. It helps grow the show so we can get even more successful guests on the program to help you. If you're already subscribed, a huge thank you. When you subscribe, you're going to get access to the program before anybody else does. So if you would, just click subscribe right here. Thanks so much, and welcome back to the Wealth Eazy Show. Yeah, well, I enjoy. I mean, you're very active on LinkedIn, and I look forward to reading a lot of your posts. Um, and I've got a couple of juniors in my practice, and I've given them this book, and I said, guys, I don't think there's much of a better book written on whole life insurance between you and Caleb, the and assets and permission to spend. I think it's just a real good testament to actually how to structure it and how to use it. The one thing in my practice that I talk about is I don't believe retirement is age specific. I think it's income specific. And most people, they've got this age in mind. When you talk to someone, you know, people go, oh, when are you thinking about retiring? Well, I want to retire at 65. I think the problem in today's society is people have this age in mind, but they don't have an income in mind. Can you talk to that? Because I know you talk about being ready, it's not age specific, it's income specific.
Well, yeah, it is income specific. I mean, the term retirement is almost ready to be retired. You know, people are moving toward a phrase called financial independence. So that's the point at which your financial assets or your streams of income or from wherever are enough to generate the lifestyle that you want so that you can give your boss the middle finger and walk out the door at any time. You're at that point, it's your choice to work. You don't have to work. So that can, you know, if you sell your company or you have some kind of windfall, even an inheritance, that could happen very young. But you may still choose to work 30 years, like just because, you know, who wants to retire in their 30s? Like it sounds good, but then what are you going to do with your day? So yeah, I think it's all about choices. It's at what point can you make that choice? And what I focus on with most of the concepts that I talk about is that risk shifting and adding guarantees into a portfolio so that you don't have to save as much. You know, the traditional retirement thought, like this is kind of the most basic 101 crude thought of what retirement is I need to save up a certain lump sum, and there is a number, and once that number is big enough in my 401k or otherwise, I can retire. So, you know, back of the napkin math is if you're taking 5% off that portfolio, you need about 20 times, you know, your desired income in financial assets. So if you want to live off $100,000, you need $2 million, you know, roughly to do that confidently forever. But that's because we don't know what's going to happen. You know, that those 4% rules or 5% rules or the rules that drive to how much we can take from that portfolio, a lot of that is driven by the expected volatility moving forward. So if we have a portfolio that's all in investments and it's all exposed to taxation at some future date, which, you know, those tax rates are still controlled by Congress. You know, right now tax rates are permanent, but they're only as permanent as politics allow. You know, you put a whole host of new congressmen in office, and 4 years later, that could be a very different tax code.
Yeah.
So that's really what I focus on is how can we get to a point where as early as possible we can create income off that portfolio, but know that no matter what happens, that's really the issue is when no matter what happens, we're taken care of. And done properly, you know, using life insurance and annuities, you can potentially save half as much as you otherwise would have to save in just a volatile investment portfolio.
Mm-hmm. Here's something that shocks me. Your research shows that most retirees actually have enough, but they're still terrified to spend it. Why is that? What's going on with their psychological mind that's keeping people frozen even when the money is there?
I still remember this when I was a new advisor. It must have been a year in or somewhere around then. And somehow I got networked around and I met with this 60-year-old client, and he was worth $3 million. And 23 years ago, that felt you could have just said a billion and it would have felt like the same number to me. Like I'm like, you're fabulously wealthy as far as I'm concerned at 21 years old. And he said to me, he's like, I get it. I've been successful. I've got millions of dollars. But I'm terrified. I'm terrified of retirement because I don't want to spend any of it. I don't know if the market's going to crash. I don't know if I'm going to live 50 years, and I can't make this money again. I was an expert in my field, and that's how I was able to get highly paid and accumulate this. But where am I going to go back to work now? I'm effectively obsolete. So it just dawned on me. I'm like, wow, multi-millionaire in retirement, effectively the equivalent of 5 or 6 million today. I'm like, and he's terrified to spend his money. And that was really early on in my career where I just got passionate about this whole concept. And like, you can be what I call, you can be a multimillionaire and be afraid. And why he was afraid is he didn't know how long he was going to live. He didn't know if the market was going to crash. He didn't know, if there was hyperinflation around the corner. He didn't know if there was a healthcare shock coming. There was so many unknowns that were not really accounted for or insured against, that he was hoarding his wealth to protect against that. It's kind of like if there was no such thing as homeowners insurance, you would save as much money as you could. You would hoard $1 million in your savings account just in case your house burned down, right? You'd have to, because there
Mhm.
was no insurance company to help you with that. And that's kind of how retirees are facing retirement. Is if all those bad things were to happen together, the results, just like your house burning down, are catastrophic. You're effectively broke before you die. I mean that is something that you can't crawl your way back out of at 90 years old. So I don't know if that answered the question, but that's really that was an eye-opening event for me early in my career, and really what I'm on a mission to help people solve now, because it's very solvable.
So when you take a look at all of the product that is out there between stocks, bonds, CDs, um, ETFs, when you take a look at everything, even real estate, crypto, and we all know that life insurance is not an investment,
Mhm.
what product do you propose or what strategies do you recommend to advisors to help their clients take away that anxiety that gives them that permission to spend?
It's permission to spend and it's permission to invest. So when you're in your 20s, 30s, even 40s, who cares? Just put it all in the market, put it in stocks, bonds, ETFs, put it in real estate, start a business. I could go bankrupt today and I have enough time, hypothetically, to recreate that wealth, by the time I retire, in the most extreme example. So that's why, we recommend younger folks take those risks, but you can't take those same risks as a prudent investor as you get closer to retirement. You can't lose half your money the day before you retire, or guess what? You're not retiring, certainly not on time. And you can't lose half your money while you are retired. So what happens to people is, at the time when they have all of their wealth, they've accumulated their millions, however many that is, they are kind of forced into a situation where they have to take all that upside potential, all that risk off the table. Risk has historically been rewarded. You should be invested. You shouldn't just be putting your money into fixed vehicles that can't go down. So it's great to have that exposure. But if all you have is investments, you're kind of forced to move into very conservative investments, stock, like bonds and cash and things that have a lot less volatility, to protect yourself against the very possible event that you do suffer a big loss early in retirement. But it's also very unlikely. We've had some major market crashes through history, and they do happen. And there is one right around the corner. I don't know if it's next year or 10 years from now, there will be another one. But most of the time, the market actually does go up. It actually does perform. And these profit-seeking companies do maximize value for shareholders, and it all works. So why do you want to be in a position where your financial plan requires you to basically leave the party, leave your opportunity for upside at a time when you have the most money to potentially compound and play and generate real wealth? And that's where insurance and annuities come in. That's where those products fit in. So there's never a product recommendation for a client. It's either there's an outcome recommendation. So depending on the client, it's going to vary widely. If you get a very aggressive client, or maybe that client doesn't have kids or a spouse that they care about, they can probably take more aggressive chances than somebody who um, has those things to worry about. But yeah, that's kind of how I
Wow.
approach it. Is we just need to have those products. And I love the title of Caleb's book that you mentioned, the and asset. When people say, should I buy this or this or this or this, and I say, yes, buy them all. I personally own them all. I own real estate, I own life insurance, I have my own business, I own stocks. I probably won't own bonds for a whole host of reasons, but
Yeah.
I have money in just about everything, because I don't know what the future holds, and neither do you, and neither does anybody else who claims they do. So that's the whole point. Is these assets have their own unique properties, so that no matter what happens in the future, you're positioned to take advantage of it.
Yeah, I mean, I've built my whole mission around exposing how the traditional financial system is rigged against everyday people, and you've spent your career inside that system too. And you're out there, you're educating people. What do you think? What's the industry secret that everyday people just don't know?
Um,
Because let's take a look where they're getting their advice from. Most of them are getting their information from large financial institutions, right?
Yeah.
Traditional advisors.
Well, I don't like being a conspiracy theorist. I think advise, especially at the advisor level, everyone's out there trying to help people,
Mhm.
but I also believe in incentives. So, and incentives drive behavior. So when you look at how financial institutions work, just the basic investment world, and you meet whether you meet with an advisor or not, the whole investment world is built around keeping as much of your money in their accounts so that they can charge you fees.
Mhm.
So sometimes it's 0.5%, sometimes it's 1.5%, but as long as they just keep your money and they get their 1% fee per year, whatever that number is. So on $1 million, that's $10,000 in fees if you're paying 1%. That's a really good business model. They don't have to do a whole lot. They just basically put their name on your statement, make you feel well served through statements and fancy online calculators and the occasional talking head, and they just get to collect a piece of your money. And the thing that people don't realize is it's not aligned with your success. If the market goes up, they get their 1%. If the market goes down, they still get their 1%. There's no performance requirement for them to get paid as the financial institution. So there's nothing wrong with that. Having that person on your side in the case where you are paying investment management fees, it's the real advantage, and all the studies have shown this, is not that person's ability to pick stocks, better than you could yourself or anyone else could. As long as you're following some basic principles of investing, you're going to be okay. It's really their ability to help you stay the course and help you manage, the behavioral aspect of it. Not making wild decisions when, Uncle Lou clues you in on some cool new idea, or when the market, goes nuts, you actually reallocating your funds to, try to time the market or take advantage of things. So I think people are just not aware of the incentives. And the incentive of these companies is to hold your money for as long as possible so that they can extract fees. That's not to say individual advisors are necessarily doing that to you, but that is the incentive of that part of the business. And my book, Permission to Spend, is, I don't want the incentive should be for an advisor to maximize income for a client. If fees were perfectly aligned, the advisor would get paid more if they deliver more income to live off of to their client, which is the stated goal of those retirement accounts. So I think that's people need. That's the thing that people need to think about is how is your advisor working for you, and not that there's anything wrong with fees or commissions, or your advisor earning an income the same way you pay your realtors or your any other professional in your life. People need to eat, but understanding the alignment is key, I think.
Hmm. I always say there's four principles that banks have is that they want you to give them all of your money on an ongoing basis. They want to hold on to it for as long as possible and then give it back as little as possible. And that's where the incentive lies, those fees,
Yeah.
right? We talk a lot on this show about why prediction-based financial advice is broken. You call it noise. What's the real cost of chasing predictions, not just financially, but psychologically? And what changes when someone shifts to principle-driven planning?
It's peace of mind. It's when you're just chasing the next headline, like, it's a fool's errand. It's been proven that nobody can do that, over time. The reason Warren Buffett, for instance, is so successful is because he's the most patient investor out there.
Mhm.
He routinely holds billions and billions of dollars in cash, just literally sitting there as dry powder, waiting to swoop in
I think
when
the
everything
number
is low.
I think the number I saw was he's sitting on 360 billion in cash right now.
Yeah, he's not buying anything because the market is frothy. Everything, it won't go down.
Yeah.
And what will happen is when the next crash happens, not if, but when the next big one
Mhm.
happens, he and his company will deploy hundreds of billions of dollars into all kinds of great companies that are just depressed in value. And that's his strategy. So going back to your point is, he has been successful because he doesn't chase emotion. He doesn't chase the latest trend. And I think that's where investors need to be. So for me, I tell the story about, the reason I own so much whole life insurance, and I think this speaks to a lot of our clients, is because of my identity. I know that my identity and how I was raised is going to really kill my retirement in the traditional model. because I am the kind of man who views myself as a provider. I am going to make sure that my kids are okay. I am going to make sure that my kids have a better life after me than I had. At the very least, I know I have an obligation to my spouse. I am not going to frivolously spend in retirement or put all my capital at risk when that could jeopardize the financial future for them. I bought life insurance, lots of permanent life insurance, because that guarantees that no matter what happens in the market or Congress or my bad decisions, my kids and my family are taken care of no matter what, in terms of, guaranteed access to capital and wealth transfer at my death. For me, it was it sounds unselfish, but it was a selfish purchase. Like I know that identity of myself as a man, as the provider for my family, as the patriarch, if you will, that identity is going to hold me back from enjoying to the maximum amount that I can all those dollars that I've been able to accumulate when I get to retirement. So that's, I think, the paradigm shift for a lot of folks is when you make those unselfish purchases like life insurance and things like those are actually very selfish decisions because it frees you up to no longer have to worry about those obligations, which, most good people who are taking care of their family, they will continue to be that person. No one just retires and says, I don't care about my family anymore.
Exactly.
Doesn't.
You have kids?
I do. We got two kids, 11 and 14-year-old boys.
Yeah. I have a 14-year-old
Yeah.
son. Yeah. What do you say to someone? What do you say to someone who, you talk about whole life insurance and they say, you know what, I'm single. I don't have any kids. I don't need life insurance.
I would say
they may
that
not need term. They may not need term insurance, but when you take a look at all the benefits that whole life offers, what do you say to someone who gives you that response? I don't need it. I don't have kids.
good. Yeah. Very few people need permanent life insurance, but if you really understand it, you should want lots of it.
Mm-hmm.
And I will tell you that the wealthiest, smartest clients we work with have tons of money in it once they understand it because of its incredible tax advantages and growth potential. Effectively over time, you get a corporate bond like return. You get complete access along the way, and you get no taxation on the way up as it grows. Typically, when the IRS is giving you tax advantages, read the fine print because there's some very tight strings attached. Like just take the 401k for example. There's income, there's contribution limitations. There's income limitations on Roth contributions. You can't touch your money till 59 and a half, or there's going to be a 10% penalty tax on top of it. If you're too rich and you don't need it, tough. The money has to come out at 73 with required minimum distribution, so the IRS gets paid. And there's just every time you get a tax advantage like that for a certain purpose, there are some serious strings attached. So when I'm talking to somebody who doesn't need life insurance, I'm like, cool. Most people don't need permanent life insurance. If you are moderately successful and you accumulate however many millions you can, like it's not a need, it's a desire, it's a want. And I think once people understand how this stuff works, I call it one of the best kept secret in personal finance. That's the subtitle of my book. I really think because it's called life insurance and it sounds so unsexy. And frankly, there are some unscrupulous people in our industry who misrepresent or missell some of this stuff. It gets this bad name or as something that you shouldn't do when it's quite the opposite. It's the advantages, the tax advantages afforded to these vehicles are pretty hard to find elsewhere.
I've always said that whole life insurance is Canada's best onshore tax shelter.
I like that.
Yeah. There's no other tax shelter in Canada that is completely legit, CRA approved. There's nothing you can touch better than whole life insurance.
Yeah.
And probably in the US too, right?
I would agree with that. Yeah.
Yeah. You completed your PhD research specifically on whole life as a fixed income alternative and under some of the top retirement scholars in the world. What did the academic research reveal that even surprised you?
Well, I think a lot of people, and this kind of goes to my comment of unscrupulous. I don't think there's that many unscrupulous people in our field that are trying to mislead people. I think it's usually just uneducated. Mm-hmm. And they'll make comments that whole life insurance gets you a better return than you can get on your own. And maybe that's a little bit true, but not really. I mean, you're going to get in whole life insurance a corporate bond like return because those dividends that the company pays are based on their general investment account, which is largely invested in corporate bonds. So that just kind of flows through to you as the policy owner. What the research was really meant to show was, or it was asking the question, because that's what a dissertation is. It was challenging. I've heard over the course of my career, whole life as a bond alternative, whole life as a bond replacement, and I always just wondered, does that make sense? Whole life insurance obviously has higher fees and expenses than you would pay, at least up front, in a fixed income portfolio for all the right reasons to pay for, all the benefits that product has. Um, so what the research showed was that, over time, it was a very bond-like return. If you compare it to any index that is roughly what the general investment account is invested in, both over time, and I'm talking 20, 30 years, are very similar in terms of performance. The difference, though, is that whole life can't go down. Through the life insurance contract, and only whole life, not any universal life format whatsoever, only whole life insurance. The insurance company guarantees that your cash values must go up. They guarantee that your cash value must equal the death benefit at age 100, and anything else above and beyond that is non-guaranteed additional, dividend performance. And once that dividend gets paid, it can never be clawed back. So if what's been true for about 175 years, all of these biggest major mutuals been paying dividends since Civil War times. If that continues moving forward, and it should, if their corporate structure is mutually owned and for the benefit of their policy owners, and there's no shareholders on Wall Street trying to extract profitability, if that continues, it's reasonable to assume that you should continue to get that, a very corporate bond-like return, but none of the volatility along the way. And that's what the research showed is that you can't really put a Sharpe ratio on it, but the Sharpe ratio on Wall Street, if you're looking at investments, I'm oversimplifying it. It's a little bit more complicated than this, but it's basically the return that you're getting over the volatility that you're experiencing. And the goal in traditional investing is to improve that ratio, right? How do we get those higher returns but lower the risk?
Mm-hmm.
We can improve that raising the returns or lowering the risk. And with whole life, you can't raise the returns. You're effectively getting the same thing that you're getting in a general investment account like portfolio. But because the insurance company steps in and guarantees upside performance and guarantees that you can't ever have a down year, they've actually, given you a better risk-adjusted return, a better Sharpe ratio on that portion of the portfolio. The catch is you got to be healthy enough to get it. You can't be on your deathbed, but you don't have to be a marathon runner. You can be average health or better to enjoy those economics. But the second piece is patience. The cost structure of these policies is generally set up such that, you don't, depending on how you design it, you typically don't break even until about 5 to 10 years in, depending on how aggressively you fund it. But then it's off to the races.
Mm-hmm.
So a little bit of I call it patience. There's different ways to put it, but that's really the catch, if there is one. It's you have to own it long enough to enjoy that improved Sharpe ratio, if you will, on your fixed income.
Dave Ramsey would say much different. Anybody who knows Dave Ramsey and Susie Orman, they bash whole life insurance constantly, and he says it's a big scam. The insurance company keeps all the cash. If you cancel, they keep all the cash, and you're better off buying term, investing in difference. What would your response be to a comment from Dave Ramsey like that?
My comment would be Dave Ramsey's talking to tens of millions of Americans at the same time. So advice kind of has to go toward the average. The solutions that I'm talking about are really a 10%er solutions. It's whole life doesn't really get super attractive in terms of its tax advantages and flexibility until you're kind of a six-figure income family.
I agree. Yeah.
If you're talking about average incomes and average net worths across the country, to buy term and save or invest the difference is probably really good advice. But I think what's missed, and there's been comments where it's been proven that he doesn't quite understand retirement income planning, is when you get to retirement, financial planning doesn't stop at age 60, right? Or 65, or whatever your retirement date is. The whole idea behind buy term, invest the difference is if you just buy cheap term insurance and then you put your money in the market, that's more money invested young, that's going to compound, and that'll give you a bigger dollar amount when your retirement date comes. That should work. In fact, that does work. If you can run it 100 different ways, that almost always works on average. But I would say two things to that. A, you are not the average, right? So if the market has averaged 10%, you can't just put 10% into a calculator and say that, look, when I'm, 37 years from now, I'm going to have this number. You don't know if in year 36 the market has a down 50%. That could be you. You have to basically time your retirement in a bull market, which you can't do. But the other piece is how the money comes out. No one ever talks about how the money comes out, and I know we've talked about that a lot in this last half hour. Is if all you do is show up at retirement with the biggest nest egg you can create because you saved all that money on insurance, then how much can you spend? And that's where the historical research around 4% rules and sequence of returns risk comes in. The academics will tell you that historically it was 4% was the worst case scenario. You add in some taxes and fees, and there's a lot of academics looking at right now how overvalued some of the markets may be. Your safe withdrawal rate could be 2 or 3% if you really want to make sure that lasts 30 or 40 years. And that all comes from playing scared. It comes from you effectively acting like your own insurance company, hoarding wealth to protect against this relatively unlikely, but if it were to happen, catastrophic event of running out of money. So that's what I would say to that. It's like buy term invest the difference, logically makes sense. It should work. And most of the time it does, but it doesn't necessarily work for you. Your actual retirement will be different. And the planning doesn't stop at age 60. It's not about the number you have at 60 or 65 or whatever your retirement date is. It's about how are your assets positioned so that you can maximally spend all of those assets without jeopardizing running out of money.
I would completely agree with you that buying term, investing in a difference is generally a good strategy for someone who, like you said, is making under six figures. Because when I meet with clients, and they're making more than six figures, I would ask them, do you think your income is common or uncommon? Like, do you even know what the top 5% or 10% is? And if they say that their income is uncommon, my response is, well, why are you using common strategies? And I believe that incorporating whole life insurance into your strategy is an uncommon strategy because it is for, like you said, the people that are making six figures and up, because it is expensive and it does take time. But you're right. When you talk about, no one really talks about how to come down the mountain. Everyone talks about, yeah, I can take you up, I can get you up the mountain, but more people die coming off the mountain. Mm-hmm. You had a slide that I really enjoyed when you did your presentation last month at your forum. And you showed, because we talk about this 4% withdrawal rate. Well, what happens in retirement when the markets drop 20, 25, or 30%? You're still taking out that 4%, but now you've accelerated those losses. And you showed a slide where this is a really good time where if you've got whole life insurance, you can pause those withdrawals and start to utilize borrowing against the policy and taking your income from there and allowing the markets to come back. And then you can actually, you showed the chart saying you can actually bump up your withdrawal rate to from 4 to 5, 6, 7, even 8% because you put a pause on it.
Right.
How did you come up with that information, those charts? Because you have some fantastic charts.
Gosh, I don't know where I came up with those charts at this point. It's not a new concept. It's effectively sequence of returns risk. For any listeners who aren't familiar with the concept, sequence of returns risk is basically, it just talks about the fact that, what helps you on the way up it actually works against you on the way down. So there's a concept called dollar cost averaging. So if you're saving some dollar amount every single month of your life, and you think about how many shares in the market that those dollars buy, when the market is on sale after a crash, you buy more, right? That's a good thing. So you're automatically buying more low. And when the market's overvalued, you're buying less shares. So dollar cost averaging is not a get rich strategy, but it is a risk mitigation strategy. It's perfect on the way up. On the way down, dollar cost averaging, works against you. So what I mean, so if you're selling on the way out, what I'm talking about is if the market goes down, you have to sell more shares at depressed values to generate the same income. So the simple math is if you have $2 million and the market goes down 10%, you lose $200,000. If you then take another $100,000 to live off of, now the portfolio, from the portfolio's point of view, it just lost 15% in 1 year. That's an even bigger loss to now claw back out of. So next year, not only are you going to take another $100,000, but the market then has to return, 20, 25% just to catch up to where it was supposed to be. So that sequence of returns risk. So having an asset that you don't have to sell low is the strategy. Having what they call a non-correlated asset. It doesn't have to be whole life. It can be cash. It can be home equity. It can be something else that is not necessarily correlated to the markets. But whole life is so good because of the return and tax profile that it gets. Where else are you going to get 5, 6, even maybe 7% year to year growth without paying any income taxes on it and have full access to it? So that's really the concept. And the way I like to put it is when you have whole life in your portfolio, and that asset is guaranteed to rise in value because of the contractual guarantees, not guaranteed zero, but guaranteed an actual increase in value. And you have enough of it. And I tend to suggest 15 to 25% of your total accessible, investable net worth, should be in whole life cash value. Then that you always have an asset that you can sell at a value that is higher than it was the year before.
Mm-hmm.
And it's almost too simple, but that really is the name of the game, is always having an asset that you can sell high. Because what's the basic principle of investing? Buy low, sell high, right? Whole life is not an investment. It's an insurance policy against all of that volatility.
Yeah. Business owners are a bit different than W-2, and here we call them T4, salaried people. They're wired to reinvest everything. And that builder mentality is exactly what makes them successful. But does that same mindset become a trap when it's time to transition into retirement? How do you rewire someone who's built their identity around accumulation?
Yeah, I mean, if I came to you and I said that my investment strategy for you is to put 100% of your net worth in Google stock because look at them, they're great. What would you say to me?
You're
Like
crazy.
that is a foolish investment strategy, right? Well, that's what business owners do oftentimes is, their business generates profitability and they pour it right back into the business. It's the nature of an entrepreneur. And in the early phase, the first few years, maybe even the first decade, that can be a really good strategy. It was said to me at one point that there's two ways to get rich. One is opportunity, selling your business or something like that, or consistent compounding, save $1,000 a month for 40 years and you're going to be great. Um, So, they're basically banking on opportunity. They're banking on the fact that they can sell their business, either to a big buyer or even just have someone take over. But in today's world, especially with AI, that is a very scary proposition. Your business in 20 years in just about every industry could be obsolete based on what someone on Silicon Valley is cooking up right now. Um, so it's all about diversification. It's taking some off the table and putting some of that opportunity money, the business money, into a consistent compounding vehicle is just smart. And it's just as a business owner, it just makes sense to always have dry powder. You don't know when the next business opportunity is going to come up.
Mm-hmm.
Just my small business, I don't know how much I might need to lay out to my next big event idea. Having money on hand allows me to make those decisions. Um, and sure, I could go borrow that money, I guess. I think a lot of business owners feel that way too. But guess what? In years like 2008, or even during the pandemic, like good luck getting that loan. You having that money on hand is really not about when things are just going great. It's really about having opportunities to pounce on business opportunities when times aren't good. And 2008 actually is a really great example. And home values were down 40% in some cases. And real estate investors today that are worth tens of millions or hundreds of millions of dollars bought a lot of property during that time when it was on sale. And if all if you're levered to the max, you don't have those opportunities.
Mm-hmm. Well, they were sitting on cash, and if they didn't have cash, they had access to it,
Right.
and that's key. Here in Canada, I don't know what's like in the U.S., but business owners in Canada who have built up retained earnings, there's only a couple ways that they can actually get the retained earnings out, and that's either by taking as income, and you don't want to do that because here in Ontario, when you start taking out income, depending on what you're doing, you can push yourself into a 54% tax bracket. If you take it out as a dividend, you're still taxed at 47 and change percent, so just shy of 48%. So a lot of business owners, they keep the retained earnings inside the business because they don't want to take it out. But whole life insurance, when it's corporately owned, allows the business owners to move retained earnings out into a corporately owned life insurance policy. They get it out tax free, but they also get access to it tax free. Do you have
Right.
that? And this is 90% of my clientele are business owners, and I show them this strategy because it really is the only financial tool in Canada that Revenue Canada doesn't challenge to move money out. Does the U.S. have? Does it work the same corporately owned life insurance to move money out tax free?
Typically not. I mean, if the business in the US, if the business owns a policy, obviously everything grows income tax free, but eventually, and death benefits are paid income tax free, but eventually when that money is rolled out to an owner, it's going to be treated as, to some degree, as income at
Mm-hmm.
some point, whether it's deferred comp. But businesses use it all the time, not only to insure against, key person risks, or create, but often also create, non-qualified deferred compensation programs for select individuals. Because otherwise you're subject to ERISA guidelines and the fact that you have to contribute for everybody in your company versus just selecting the few that you want to.
Mm-hmm. You know, people are living longer these days, and with AI, economic uncertainty, the landscape is shifting fast. How does that change what retirement actually looks like for the next generation? And are the strategies we've been using, are they keeping up?
No, the strategies aren't keeping up. They're actually hurting retirees. So back in the day, you would work for an employer for 30 years, hypothetically. They'd give you a pension. And the longer you work for them and the higher income that you earn, they will pay you a pension. Those still exist all over the place. Usually it's relegated to governments now, where they'll pay you 75% of your last 3 years of income or something like that for in perpetuity. But what's shifted is now we're in the defined contribution era, where it's up to you to create that same nest egg. So you've got to accumulate those millions of dollars to retire off of. And that's the disservice that the industry has done in the name of independence and being able to do it yourself, and all that good phraseology. They've effectively made a system where you have to quit your career that you spent your life in and turn into an investment manager, and now manage this bucket of assets carefully over the course of your life, and expertly spend it and invest it so that you can spend as much as possible in a whole sea of uncertainty. So the industry has done a lot of good for people, giving them 401ks and matches and tax advantages along the way, incentives to accumulate money for retirement. But there's no education out there, none that I have seen, that effectively talks about how the money comes out in the most efficient way.
Mm-hmm.
I believe the most cutting edge financial advisors that I talk to are the ones that understand exactly how to spend that money down to as close to zero as possible by the time you die, while still making sure that your obligations or your legacy, goals are funded. That's No one's talking about that.
Mm-hmm.
It's just not out there.
There's a lot. Listen, there's a ton of information on if you want to create wealth, and
Easy.
if you want to build a good retirement portfolio. But you're absolutely correct in saying there's not a whole lot of information out there on how you actually get to spend and enjoy that safely.
And and the issue is, so a lot of people say, well, fine, I'm in my working years, I'm just going to focus on buying term, investing the difference, maximizing my income, saving as much as possible. The good ones are doing that, and I'll worry about retirement when it comes. But with everything else in life, this is true. The longer you wait, the more reactive you are, uh, the the worse chances you have for success than someone who was proactive or thinking ahead. If you can make the right decisions in your 40s and 50s or even earlier, then you can get to retirement with very similar dollars, but have way more options and flexibility to spend those dollars down. You can do it at 65, but your options are far narrower than if you had started before. So that's I think the thing people don't understand is they're just, I'll deal with it when I get there, and you can, but to the extent you can plan ahead, you'll have far greater opportunities to spend and enjoy that money.
Yeah. Your book, Permission to Spend. I love the title, by the way, because it reframes everything. Who was that book really written for, and what's the core idea that you want someone to walk away after reading it?
I think the core idea is that it doesn't require more. So permission to spend is all about the concept that you will be afraid to spend when you get to retirement. I don't care if you're worth 5 million. I don't care if you're worth a bunch of money. You will be afraid to spend because you don't know. You don't know if you're going to live to 115. There's plenty of people alive today that will live that long, as people live longer. You don't know if there's 3 world wars coming down the road. You don't know if the AI army of robots is going to change our lives. There's so much you don't know, that you prudently will just be forced to sit there and hold back. And the concept of permission to spend is really for the pre-retiree. So I don't like to put an age on it, but people in their 40s and 50s who have serious, resources to allocate toward things. It's not about it's not about saving more somewhere else. It's really about the reallocation of assets. I call it the 2% solution. If you at 50 years old were just to take 2% of your total net worth and shift it into permanent life insurance, your options at retirement would be dramatically different. So if you're worth $1 million at age 50, your total net worth, you just took 10 grand a year, or excuse me, 20 grand a year, that's 2%, and moved it into permanent life insurance, your options at retirement would be dramatically higher. And that's a starting point. Some people do 3, 4, 5%, but the whole idea is it's not save more. It's not just, plow more money into your retirement accounts. It's start to shift assets into other types of vehicles that have other risk profiles, that have other contractual guarantees. And I think that's the shift. That's the shift people need to think about well in advance.
And when you say, just for my listeners who don't really understand a whole lot of it, I mean, if they're listening to my show, they should understand a lot of whole life insurance because I'll talk a lot about it. But for the people listening, when you say their options can be a whole lot better, you're talking about the growth in the cash value at retirement.
Growth in the cash value, but the ability to annuitize. For instance, a 65-year-old male today could take $1 million and buy an annuity that would pay him $78,000 per year for as long as he lives. So day one, that's 7.8% of the $1 million would be coming into. As early as year 12, he gets all of his money back, and then every year thereafter, he's just in the insurance company's pocket for more and more income. He bought a pension.
Yeah.
That is tremendous. Now, the alternative is if you have just $1 million of investments and you don't know how long that's going to last, you don't know how long you're going to last, then rules like the 4% rule or 3% rule are very prudent. You should be spending way less than 7.8% to make sure that money lasts. That could be half as much income. At 3.9 is 0.5% of the 7.8 I just described. So the point is, your ability to spend, your ability to annuitize those dollars becomes much greater if you have a permanent death benefit. In that case, if I own $1 million death benefit that I know my family is going to get, then I'll trade in all my money for a pension. I'll give me a pension that I can't outlive. And yes, there's now no more money left for my family, but I don't need more money left for my family. My insurance policy is doing that.
Well, because it's not dependent on the markets.
Not dependent on the market. Yeah. So
there's no volatility.
That roughly is my retirement plan. And I don't really worry about what the market's doing. I may never worry about what the market's doing. I will probably stay fully invested in the market right through my retirement, because I won't have to take my foot off the gas. I won't have to make those tough choices that people without protections in place are going to have to.
Well, I think it also, too, it removes that anxiety being afraid to spend, because every January 1st, you're going to wake up and go, I just got $78,000 put into my bank account. I'm not afraid to spend it because I know I've got this for the year, or if you're getting paid monthly, every month I know I've got a check going into my account. I'm not relying on the market. When we talk about, you've trained so many advisors and you've sold over 25,000 copies of this book. You're out there, you're a keynote speaker, you're coaching. What's the one thing that still fires you up?
One thing that fires me up, I'm getting more and more fired up about the message we're talking about today, which is the laziness of advisors. It's very easy as an advisor to hide behind reasonable doubt, if you will, or defensible solutions. If you show someone an asset allocation model and a financial plan this thick, and the projections show a 98% chance of success, it's very easy to just deliver that plan, collect the investment assets, meet with them once a year, and say that you're doing a great job. And you know what? Most of those advisors are doing a great job. Like those clients are better off because of that person being in their life. So I don't want anyone to take that the wrong way, but that advisor is only doing half the job. Like they are a wealth manager, they are an asset accumulator, they're an accumulation focused advisor, but they're not talking to you about the last 30 years of your life. They're not telling you exactly the strategies to take every single dollar out of those accounts. And for me, that's what I'm fired up about is it's I see this happening to the industry. The financial planning world as we know it today was built by these major mutual insurance companies. They're the ones that kind of coined a lot of the phrases around planning because they are doing planning against things that can go wrong. And many of them have moved away, or the advisors in those space have moved away from talking about insurance to just talking about investments. Not because investments are better, it's just sexier and more fun to talk about. It's CNBC. It's I call it financial entertainment. You turn on CNBC and there's like ticker symbols going across the bottom. Nothing could be more meaningless to your finances than those
Yeah.
than those ticker symbols on a day-to-day basis.
Yeah.
But people love seeing them, right? And I think that's going to continue to erode the financial planning world in a world where just it's the hard conversations are the ones that actually move the needle for people.
Yeah. Guys, if you don't have his book, I really suggest you going out and ordering a copy of Permission to Spend. I think I got this on Amazon, but where can people get this book? Is it Amazon? So I
Yeah,
think I
and
got it from Amazon.
available in all formats on Amazon, and hopefully within the year I'll have version 2 coming out. So
Oh, I'd be looking forward to reading that. Tom, this has been awesome. I really want to thank you for your time. Where can people find you? If there's any advisors out there that are listening to the show and you want to get involved with Tom's mastermind, I'm involved. I just joined up last month. Every second Wednesday, he has a call, stays on, answers questions. How can people get a hold of you?
yeah, so if you're an individual, permissiontospend.com is a good place to go. If you're an advisor or you run a firm, they actually have 2 places you can go to. TomWallTalks.com. That's my speaking business. So if you run a firm and you want to have this kind of culture in your firm, that's a great way to connect. And if you're an advisor, go to wholelifemasterminds.com. It's specifically unapologetically titled that because we're focused on how to properly position this stuff in a way that moves clients to action, changes lives, and kind of fights some of the noise that is out there in the mass media about that really misrepresents all the good that it does.
Mm. Amazing. This has been awesome. And LinkedIn, what's your LinkedIn? Because you post a lot of really great content on LinkedIn.
I mean, Tom Wall at LinkedIn, I'm not hard to find.
Okay. Well, this has been awesome. Guys, that's all the time we have for today. If you like this episode, please like it, share it, subscribe. Take care of your wealth and your health.